What a day, what a day. The Fed comes out and shocks financial markets. Ostensibly, they deliver exactly what the markets were looking for, at least looking at market pricing, but it looks like everybody, myself included, were looking for a more gradual Fed than what the markets were looking for and didn't get it. So carnage reigned. Now we have another central bank in the offing with still more volatility perhaps on the docket. This is Macro Money. I'm Ilya Spivak, head of global macro here at tastylive, and we're going to touch on the Fed a little bit. There's, of course, been quite a lot said already. And I encourage everybody to check out the live stream on tastylive trending on YouTube of the conversation we just had on overtime around what happened with the Fed. And then tune in just 30 minutes after we're done with this show to that live stream. After this, we'll be talking with Victor Jones on the price of truth for a full 90 minutes and no doubt dig around the Fed in granular detail. But what we're going to do here today is focus on the Bank of England, which has a monetary policy announcement immediately following the Fed and perhaps going down the Fed's example and creating a bunch of volatility in its wake. So let's consider here how the table is set, what is expected, why it is expected, and where the vector for market action here may lead. Of course, we'll touch on the Fed a little bit as we go, because needless to say, after a day like this, we have quite a bit of context from U.S. monetary policy. So the expectations here are that the Bank of England is going to keep rates unchanged this time. What we're looking at here is the equivalent of Fed funds futures. These are 1-month SONIA futures, the benchmark rates indication for the Bank of England. And we can see here the current target for the bank rate, the target interest rate, 4.75%. Looking at December, we don't quite have the cut there. We have the next one on the menu, it looks like around March. And then we can see here we get to another one by September, November. And as we can see here, the curve for this policy path into next year is a significantly less steep one than what we saw back in September. The markets were looking for a much more dovish Bank of England, and since then, things have adjusted to a less aggressive setting, to a more measured path forward for rates. We see here, if we look at what's expected for this year, for next year, and then in total going forward here is another 2 rate cuts basically through the end of next year. And that's been a significant adjustment from even just recently. 82 basis points was on the menu when we looked at this as recently as the beginning of this month. In fact, just last week, the beginning of last week, a much more dovish disposition for the markets. And now we're down to just 50 basis points, of which clearly we can see all of the cutting centered on next year. And a lot of this adjustment comes this week and indeed over the past 48 hours, because what we got here in the lead up yesterday was an update of UK inflation data giving us numbers that are plainly going the wrong way. And although we had a situation here where the headline number, the 2.6% here that we see for headline CPI, that was in line with expectations. The core reading, a little bit warmer than the markets were anticipating. And so what we end up with is a story about a central bank that is ostensibly being directed into a less dovish direction. Now, the markets, in fairness, had forecasts that looked for a 3.6 reading on the core. At 3.5, it was a little bit lighter, but also an uptick from the 3.3 in October, and at 3.5, the highest that it's been since August. The headline at 2.6, the highest that it's been since March. So inflation seemingly going the wrong way here for the Bank of England. And what's interesting even more than the headline numbers are the components. If we look here at what the contributing factors were to November's CPI, we can see that there was a bit of a bump from fuel, and we can see that was very close to where the contribution was for the previous month. So of the 2.6% year-on-year rise, about 39 basis points was accounted for in essentially energy and fuel. But the real standouts, 51 or 0.51 percentage points, 51 basis points from recreation, about 0.6 percentage points or 58 basis points from hospitality. These were the real standouts. And this has been the case for a few months now, which is an interesting kind of a disconnect, because you would think these would be the parts of spending that would be the most vulnerable to the business cycle. If people were going to cut back expenditures on something, it would of course be not on food or clothing, or perhaps even on transportation, or certainly fuel. It would be discretionary spending, recreation, hospitality. But it's these places where inflation is proving stickiest, even as the business cycle actually seems to be going in the wrong direction. So when we got the updated December Purchasing Manager Index figures earlier in the week, the story was, to put it gently, a disappointing one. We're basically back to standstill on the UK economy. If we recall, of course, PMI numbers work around a center line at 50, where that's neither expansion nor contraction. Above 50 is expansion. Below 50 is contraction. We came in at 50.5 on the composite, which subsumes within it both manufacturing and services. Services wiggled a little bit higher from November's lower reading up to 51.4, but the overall composite at 50.5, that is a rehash of what we saw in November, and that is the lowest reading on UK economic growth that we've seen since October of 2023. So we're talking about the weakest growth in well over a year. And what that's following is a steady deceleration from where we peaked in August. And if we look back even further, here's August. That's sort of the straight line down here. But the top on growth really occurs a little bit earlier. It occurs here. So there's a sort of pickup in the second half of 2023. And as we get into the beginning of 2024, much like in the Eurozone, for that matter, where there was some weakness toward the tail end of last year that the region tried to shake off at the beginning of this one and ultimately failed. Here, a similar story, although not as dramatic. The Eurozone now outright contracting in terms of economic activity growth for a couple months in a row. The UK has not gone that far, but the growth story is certainly disappointing. we've been basically trending toward weaker growth than since April or so, where we peaked for this year. So we're looking now at an economy that really should be putting a degree of pressure on discretionary spending and starting to eat away at the influence of those kinds of categories here in CPI, and is plainly not doing that. Moreover, if we look at the way that economic data has performed in the UK relative to forecasts, just to get a sense of economic momentum, here it is a story of deterioration also. We can see here there has been a steady weakening in the performance of UK economic data relative to forecasts. So not only are things trending toward weakness, they're also weaker than expected. So not only is the economy weak, but the numbers that we see coming out here are weaker than even the forecasts have it. And so the upshot then is we really should be seeing, against these kinds of economic conditions, now for a few months running, a diminished impact from discretionary spending. And frankly, at least when it comes to recreation, what we're seeing is the opposite. Its contribution actually increased as an influence on CPI from October to November, and didn't change very much at all when we look at the hospitality side of things, which of course makes for a very curious conundrum for the Bank of England as it ponders what to do next. Now, it certainly makes sense that against this backdrop, at least on the inflation side of things, we've seen a hawkish adjustment in expectations, but also the Bank of England has to be mindful of the fact that it's operating as central banks do with lags, and has to be mindful of the fact that ostensibly the weakness that you're seeing in economic activity growth will invariably land you into a place where you have to start thinking about more stimulus, not less. So how the Bank of England is going to walk this tightrope will be very interesting to see. It's not dissimilar from the tightrope that the Fed's been walking, although there it's a little bit clearer. The Fed had an economy that looked like it needed more stimulus in September. It promised big things, 100 basis points this year, 100 basis points next. It's had to walk back half of its 2025 forecast in today's update, which is what gave the markets the indigestion that they got once they saw it, even though they were already priced for that. And so you end up then with a situation where there is a balance of risks and a fine road through the middle. And for the Bank of England, it's even more overt, because the economy is weakening, which seemingly calls for cuts, but inflation, even though it ought to be responding, isn't. And so there's a difficult case to make for easing. So the way that policy decision-making happens at the Bank of England is it's actually a very straightforward democratic kind of process where the 9 members of the Monetary Policy Committee vote to either cut, hike, or hold rates unchanged. When we look at what happened the last go-around here, when the central bank met in November, we can see that no big changes here other than, of course, the policy change itself. Then the vote was 8 of 9 voted for the cut, nobody voted for a hike, and 1 of 9 voted to hold. We're expected to see a perfect inversion of that this go-around, where 1 out of 9 votes to cut, 8 out of 9 vote to hold, and nobody votes to hike. The differences in these voting patterns will be very interesting for the way that the consensus is going to develop here. Now, if what we're seeing in recreation, if what we're seeing in hospitality basically speaks to baked in labor costs that got nudged up there during the pandemic, much as those kinds of labor costs in these same areas got locked in a lot of the developed economies. If that's what's going on here, if this is basically service sector inflation that's stuck because of locked in labor that was hired at higher rates in the very tail end of the pandemic as things started to reopen, then the argument would be, well, what we need to do is we need to hold rates higher and squeeze the economy further to really get this inflation out. But of course, if the economy is already weakening and policy operates with a lag, you likewise don't want to overshoot. So how the Bank of England votes on this, which side of this policymakers are going to err on, that will be very important. And if the guidance seems like maybe even the 50 basis points next year look questionable, maybe the Bank of England isn't even prepared to commit to that, then another hawkish surprise similar to the Fed might be in store. And just to give us some context there, here was the response to the Fed. Shocking this should not be, considering how much of a hawkish surprise the markets seem to find here. We get about a close to 3% surge in bond yields across the curve. Big move in the 10-year, big move in the 2-year of similar magnitude. And then a similar magnitude decline in the S&P, a 3% down day. You likewise, of course, get a sell-off in the NASDAQ. That one's a little bit jumpier in general, and so not surprising that this percentage change is a little bit larger. You also get a sell-off in gold as the dollar rallies and yields rally. Euro off over 1%, yen close to 1%. Bitcoin, obviously a kind of digital foil to fiat currency and also to yields, since it doesn't yield anything, gets absolutely shellacked today, down almost 6%. Not surprising in a higher yield, higher dollar environment, and also a risk-off environment, as we can see on the stocks side of things. But what this tells us is a sense for how markets feel about monetary easing here, which is to say risk appetite wants their rate cuts. So if the Bank of England follows the Fed example to some extent and essentially says, well, we're not going to fight the Fed, nor are we prepared to say that inflation is doing what we need it to, because clearly it seems to be ticking in the wrong direction, and those things that need to be coming out of it are not, even as the economy slows. If that's the way this goes, well, then the upshot becomes very similar for the related markets. And in particular, where this is most interesting is the British pound, where, as we can see, we had a sharp move lower today as the dollar rallied, but we didn't really cross the Rubicon, as it were. We tried to dip back below support at the 126 level, give or take here, but we're still sort of within this digestive zone down here. If we get a more hawkish Bank of England, this has the possibility of reversing higher and bouncing off these levels. And so this will be a really interesting thing to watch, because, of course, if the Bank of England decides it wants to pay more attention to the economy and look through the latest inflation numbers and say, well, we expect that eventually this economic weakness will catch up, then the story becomes very different. And then you build on this move and perhaps even break through this low at about 24.50 or so, near the 25 figure, and extend further down. The major support here, of course, the lows from just before mid-year, late first half at 123. But anyway, you slice it here, the pound is coiled up for a move, and the Bank of England is walking a very narrow path to try to balance these conflicting influences. So almost any way you slice this, an expansion of volatility seems to be on the cards. Which way this breaks might well be the start of something either way, be it on the upside or the downside. So opportunities here seem to be very interesting indeed. And that is macro money for today. As ever, we are here right after overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I am likewise on in just 30 minutes time, as we mentioned at the top of the show, on the price of truth with the great and powerful Victor Jones. That's going to be no doubt a spicy conversation today as we unlock all of what's going on around these markets. So definitely come and join for that. I'm back with Chris for Futures Power Hour Fridays and Mondays. Back with Victor and Tom for First Call on Sundays. Writing for the news and insights portion of tastylive.com and commenting on the platform formerly known as Twitter, as well as on Blue Sky at Ilya Spivak. Thanks very much for joining. Macro Money is back tomorrow.